Welcome to the Georgia Economic Outlook. I would like to present University of Georgia's president, Jerry Moorhead, to open the program.
Good morning, and thank you for joining us today. I'm Jerry Moorhead, president of the University of Georgia, and it is my privilege to welcome you to the 38th Annual Georgia Economic Outlook, hosted by the Terry College of Business. I wish we could all be together in person for this exciting event, but I'm grateful for the technology and the hard work of the event organizers that have made it possible for us to be together virtually. The COVID-19 pandemic has forced all of us to adapt, and I could not be prouder of the ways that UGA faculty and staff have innovated to continue carrying out the university's vital teaching, research, and service missions to help our state cope with this crisis. This morning, our speakers will deliver the kind of economic insights that make this annual leading resource for economic forecasting in the state of Georgia so vital. Although the customary statewide tour has been sidelined this year, we are very proud of the outstanding reputation that the Economic Outlook series has established over its long history. I know that Dean Ayers and the Selig Center staff look forward to returning their traveling roadshow of luncheon programs around the state this time next year. Today's program provides businesses and public officials with the most recent economic data needed to make informed decisions that benefit the citizens of Georgia. We are honored to have Dr. David Altig, Vice President and Director of Research at the Federal Reserve Bank of Atlanta, as our keynote speaker. Dr. Altig will deliver the national forecast, and Terry College of Business Dean Ben Ayers will deliver the state forecast. The Economic Outlook is just one of the many ways the University of Georgia is helping to promote business innovation and growth across our state. Another way is the Small Business Development Center, which helped more than 3,000 small businesses receive $88 million in federal funding this year to keep hardworking Georgians on their payrolls during this pandemic. UGA's Cooperative Extension worked with the Georgia Department of Agriculture to help coastal fishermen and seafood distributors find new markets for their catch when the restaurant industry was shut down. Research conducted by faculty and students at the University of Georgia also contributed to our state's economic growth through the development of new products. UGA is consistently ranked in the top 5 among US universities for driving new products to the marketplace. More than 800 products based on UGA research have been brought to the market today. And we have been ranked in the top 10 for licenses and options with industry for more than a decade now. Many of these products and licenses are for treatments and vaccines for deadly diseases such as COVID-19. I can share some exciting news that one of our faculty members, Dr. He in the College of Veterinary Medicine, has developed a candidate vaccine for COVID-19 that can be administered via the nose and does not require ultra-cold storage, making it more accessible than other potential vaccines to communities worldwide. This vaccine is licensed to his startup company and is being manufactured right now for an upcoming phase 1 trial. UGA continues to advance the Innovation District Initiative to further promote economic development locally and across Georgia. the renovation of the Spring Street building, located at the interface of historic North Campus and downtown Athens, is on track for completion in January to further expand faculty entrepreneurship and industry engagement. In recognition of our institution-wide commitment to economic growth and opportunity, UGA was once again named an Innovation and Economic Prosperity University this fall by the Association of Public and Land Grant Universities. We are proud to work with business and government partners and many others to improve lives and strengthen communities throughout Georgia and beyond. Now it is my pleasure to introduce Dr. Benjamin C. Ayers, Dean of the Terry College of Business. Dean Ayers holds the Earl Davis Chair in Taxation. He came to UGA in 1996 and served as director of the college's highly regarded Toll School of Accounting for 9 years before becoming dean in 2014. Under his leadership, the Terry College completed a successful capital campaign, raising $195 million to support faculty, programs, and facilities, and dedicated the new home of the Terry College of Business on the UGA campus, known as the Business Learning Community. In 2016, the Terry College established a campus-wide entrepreneurship program, and 3 years later opened Studio 225, the university's student center for entrepreneurship, located in downtown Athens. Over the past 7 years, the college has launched several dual degree programs, a new master's in business analytics, market-driven certificates and specializations, and a new academic minor in business. At the same time, the college has grown undergraduate and graduate enrollment and achieved the highest percentage employment rates for graduating students in the college's long history. Dean Ayers serves on the boards of Synovus Bank's Northeast Georgia Division, Benson's Incorporated, and the CFO Roundtable. Let's hear now from Dean Ayers, who will introduce our keynote speaker.
Thank you, President Moorhead. We appreciate you being with us, and we are thankful for your leadership at the University of Georgia. Let me begin by managing expectations of the audience joining us. We're going to cover a lot of ground in the next 40 or so minutes. Following my introduction of Dave Altig, he will give the presentation of the national forecast, and then I'll return with the Georgia economic outlook. Dr. Altig and I will split the time that we have remaining, and we will wrap this up by the top of the hour. With that, we're pleased to bring you the expertise and perspective of Dr. David Altig. He is, of course, the Director of Research and Executive Vice President of the Federal Reserve Bank of Atlanta. He oversees the bank's research division and advises the Atlanta Fed President on monetary and other policy issues. Dr. Altig is taking on the mantle this year as Vice President of the National Association for Business Economics, and he is an adjunct professor of economics at the University of Chicago. Before joining the Atlanta Fed, he was on the research staff at the Federal Reserve Bank of Cleveland and began his research career as a professor of business economics and public policy at Indiana University. He's going to take us through the national economic outlook and related impact of the COVID-19 pandemic. Dave, the stage is all yours.
Thanks, Ben. It's a great pleasure to be with you today. I have to tell you that being in the business of forecasting, which I am, means that you can't have too well developed a sense of shame. Even in the best of circumstances, you know that your projections are going to be wrong along some dimension with 100% probability. That's always the case, but there has not been a circumstance in my lifetime where I think it's been more challenging to get out the crystal ball and sort of be able to, with great confidence say where we're headed. Nonetheless, that's what I'm going to do. So it's important for me to point out that the views I'm going to share with you are really views from the staff of the Atlanta Fed. They don't represent the views of the Federal Reserve System, the Board of Governors, or anybody else for that matter, except those of us toiling in the business in the virtual halls these days of the Atlanta Fed. So here's what the economy going forward, the national economy going forward looks like to us. This is a picture of the trajectory of gross domestic product, the broadest measure of economic activity that we have. The way this picture is constructed is that 100 there on the vertical axis represents the level of GDP at the end of 2019. So you see the huge dip in production through the second quarter, and then the gradual return through the third quarter, and then our view going forward for the next couple of years. And the important thing to recognize now, so I say our views, these are actually the forecasts from the Wall Street Journal panel of forecasters. The solid line represents the median of those forecasters, and then the shaded area is sort of the range of projections. This is really not different from our view of where we're headed over the next couple of years at the Atlanta Fed. If you're thinking in terms of growth rates, this would imply something on the order of a contraction this year of 2.5 to 3.5%, depending on how the fourth quarter comes out. And then above trend growth for the next couple of years, maybe something like 4% next year, and then something slightly lower in 2022. But if that forecast comes true, then we will have essentially returned to the level of gross domestic product that we were at the end of last year by the end of next year. So that's not exactly normalized, because under normal circumstances, of course, we would have been experiencing positive growth throughout this period. So we won't sort of be at our potential, so to speak, by the end of 2021, but we will have recovered sort of the lost ground on the assumption that growth next year is somewhere around 4%. Now, that assumption is predicated on a couple of key factors. The first being that fiscal support is not done. So embedded into our projections in any event, I'm not quite sure what all of those Wall Street Journal folks have in mind exactly, but to come up with those sorts of numbers in our shop, we're actually assuming another fiscal package to be passed. And I think if we're lucky, we'll see it, the momentum that we've seen over the last couple of days, end up in something in the next couple of weeks. But certainly by the end of the first quarter, a fiscal package of, we're not very precise about these things, but somewhere in the neighborhood of $1 trillion to $1.5 trillion is foundational to our view of the economy going forward and returning to even by the end of 2021. And this picture here really sort of illustrates how important that fiscal support has been in the recovery thus far. So the solid black line here is personal income, disposable income changes over the course of the year. Again, sort of if you look to the beginning of this chart, we're thinking about the level of disposable income in February, right before the pandemic hit, and then tracing through time. And what the chart does is it decomposes the components of changes in disposable income through time. So if you're thinking about disposable income, it's basically what you earn from working, what you earn from your non-labor sources like investments, plus benefits from the government minus the taxes you pay. And the important part of this chart is that blue shaded area, which is the part of disposable income in the economy that's coming from labor earnings. So it's what workers are receiving in the form of wages and salaries, and those have been negative numbers. So this positive performance of income in the economy is really driven by primarily by government support in the form of unemployment insurance, in the form of payments from the CARES Act, and so on. It has been absolutely critical. You've heard, I think, probably everybody in the Federal Reserve System make this point and make the point that a continuation of the recovery and positive growth in the next year really is based upon the assumption that we get additional fiscal support. It has been the case that consumers have not been what I would say irresponsible or profligate or unaware of the risk going forward in their own behavior. So you can see this is a picture of savings rates by households, which has absolutely exploded, reflecting the fact that people are quite aware that these supports are designed to get them from point A to point B in this crisis, and are acting accordingly. That is concentrated. If you look into the details of this statistic, that's concentrated at higher levels of income, as you might guess. At the lower levels of income, there's a closer tracking of consumption spending, consumer spending, and income, which sort of adds up to the case I was making really in the previous chart, which is whether or not the consumer can remain resilient across the board in the face of continued struggling with slow activity in the economy associated with the pandemic is going to depend in large part on whether or not some non-market support for personal income is going to continue. If it does, I think the outlook looks pretty good, but one thing that we all know that bears repeating is that the circumstances across sectors in the economy is quite dispersed. Total retail sales, that is, if you just think about the macro economy, total retail sales have at this point reached and surpassed the level that they were at back in February. So again, this is a chart that sort of starts the world in February and thinks about where we are relative to February levels of activity. Retail sales is now above that 100 benchmark in this chart, but it is very, very different depending upon what sector you're thinking about. And all the usual suspects are in the positive and negative territories. The most obvious being if you're in a brick and mortar retail operation, your production and your activity has fallen and not recovered, and not recovering very quickly. If you're an online retailing or non-store retailing, not only are you above the levels of February quite comfortably, you never really kind of experienced the downturn. So the key challenge here, of course, is to figure out whether or not this sort of differential performance across sectors is something that's going to persist and be structural when all is said and done, or whether sort of the bridge support of fiscal policy can get us from point A, B, and back to something that looks like the pre-pandemic norm. Now, obviously, that those sectoral differences in economic activity are reflected in the labor market. If we look overall, about 60% of the losses in jobs associated with the arrival of the pandemic have been recovered. That's still quite a long way from normal, and is different depending on what sector we're talking about. And of course, the original impact is very, very much different. So the parenthetic numbers on the labels on the horizontal axis there reflect the initial impact of the coronavirus before recovery in the labor market, basically in February and April. So you can see that employment in the leisure sector fell by 50%, whereas in manufacturing it was 11%. Across the economy, the decline was about 15%. But again, the circumstances are very much dispersed and very much dependent upon where you sit, something that's really not a surprise to anyone. One of the implications of that is in this chart here. And what I've done in this chart here is I've split up jobs in the economy into occupations that are identified by skill level required in those occupations. So I've got low skill, middle skill, high skill. Low skill would basically be sort of your service sector jobs. Middle skill would be construction and manufacturing. High skill would be management, professional jobs, bankers, and so forth. The green bars here in this chart represent the share of jobs in those occupation buckets in February of this year. And the orange bars represent the share of losses borne by people in each of these types of jobs. So if you look at the green bars, basically the middle skill and high skill jobs, manufacturing and professional jobs, account for about 80% of jobs in the economy. Those lower skill jobs represent something a little bit less than 20% of the jobs in the economy pre-pandemic. But of course, the orange bars indicate that disproportionately the job losses have fallen to these lower skilled jobs, as you know, and as was reflected in the fact that the leisure sector, for example, lost 50% of employment between February and April. It's important to note that the job losses are obviously distributed across the economy and across the different types of jobs in the economy. And in fact, the number of jobs lost in low skill is not greater than the number of jobs lost across the rest of the economy. But disproportionately, this is the sector that's hit. And this is not always the case in downturns. You might think that that's typically the types of jobs that get hit hard in a recession, but that's actually not the case. So I have a comparison here of the share of job losses in the Great Recession and associated with the financial crisis of 2007, 2009. I know that Ben has some charts that make a comparison across these events as well. And what you can see is that whereas you might characterize the recession this time associated with the pandemic as hitting the low skill sector the hardest, proportionately in any event, it was not the case in the Great Recession of 2007, 2009. In fact, that was a middle skill recession. And the negative bar there in the low skill category means that proportionally low skill workers weren't hurt really at all in that recession. So this is a very much flavor, a different flavor than the last recession. But what happened in the last recession is still with us. So here I've sort of traced job levels and across these different skill categories as we go back starting in 2007. So you can see here the low skill is blue, the middle skill is red, the high skill jobs are green, and you can see sort of the low skill jobs hanging up in positive territory, This is not seasonally adjusted, and that's why there's all this choppiness in the picture. But you can see there's really not any sort of negative impact back in 2007, 2009. It's all showing up pretty much in the red line, the middle skilled jobs. And the middle skilled jobs never recovered. And that's the important part of this picture. And now we get to today, you can see the sharp drop off in the low skill jobs, as well as the impact still on the middle skilled jobs. And I want to just think about that in my closing minutes a little bit harder. It means to me that we have some major challenges associated with this pandemic when it is all over, and addressing the labor market issues associated with lower skilled workers, with the persistent challenge that is still with us from the last recession. So this is challenge and opportunity. And we've been thinking an awful lot about the workforce development challenge confronting us on the other side of this particular recession that is piled upon top of the challenge from the past recession. So I want to consider a hypothetical example. This is a young woman who apparently lives in the 1940s that we call Leah. She's a 25-year-old single mother of one child, age 4. She was working in a movie theater prior to the pandemic and at minimum wages that is associated with this type of job, receives a set of pretty common benefits for someone at these income levels: child tax credits, food assistance, and medical care subsidies. That job is likely not to exist or exist in the same numbers on the other end of the pandemic. And the opportunity here and the challenge here is to use our workforce development systems, which importantly involve our university system across the country and the state of Georgia in particular, to address the challenges of people like Leah and people in the circumstances of those middle skill jobs back prior to the 2007, 2009 recession. And what I basically want to emphasize is the return to the public, the return to the taxpayer of taking this opportunity and mobilizing our educational system and our workforce development systems to address the old and new challenges in the labor force and the lost jobs associated with these downturns. So here's what I'm going to think about. I'm going to think about taking Leah, putting her into a workforce development program that qualifies her to be a computer support specialist. I know that in Dean Ayer's slides he's going to point out some of the opportunity occupations that exist in the state of Georgia. This is IT is one of them. And so what this chart basically says is, what does the taxpayer gain if we can move someone like Leah from a minimum wage job to something like a computer support specialist, which now is one of those sort of middle skill jobs? And the answer is, over an extended period of time, over Leah's career time frame, the return to the taxpayer is about $275,000 in present value. Meaning any investment we can make that doesn't cost $275,000 for Leah is a net benefit to the taxpayer. So we're thinking now in terms of various sorts of support to get us through this. One is monetary policy, and the Federal Reserve has been very clear that it does not intend to move off of its accommodative stance anytime soon. The last we heard from them, their projection is interest rates, policy interest rates will stay near zero for as far as the eye can see, in some sense, through the next several years if things play out as projected. I've noted the need for fiscal support to bridge us from point A to point B. Here is another element we need to be thinking very seriously about. How do we shore up the timber of our labor markets and take this opportunity to move people to permanently better positions, which benefit both them and all of us as taxpayers. So thanks for your time. I will, at this point, turn it back to Ben.
Thank you, Dave. Appreciate your insight into the national economy and the impact of the COVID-19 pandemic and impact and issues associated with the workforce and our outlook for our future. Our highest priorities at Terry College are preparing our graduates for a lifetime of success and advancing economic development in the state of Georgia and beyond. And as part of our efforts, we provide timely research on economic conditions around the state, and today's program is a great example of our public service and outreach mission. Our goal is to provide students with an education that is highly valued in the marketplace, enhanced through high impact experiences like internships, consulting projects with leading companies, and study abroad. Currently, 10 of the Terry College programs are ranked among the nation's best. It is because of the wide base of support from our alumni and from the state of Georgia that our students aspire to more, they achieve more, and are better prepared to both serve and lead in their communities and professions, even in a pandemic. Over the past 4 years, 95% of our graduates have found employment in careers consistent with their aspirations within 3 months of graduation. And this bodes very well for our graduates, but also importantly for the state of Georgia. So now let's talk about next year's forecast. The 2021 economic forecast for the state of Georgia is positive, reflecting continuing recovery from the COVID-19 recession. Absent another lockdown of the population and broad shutdown of the economy, the COVID-19 recession is over. It lasted 3 months, making it the shortest recession on record. It was short because the fiscal and monetary policy responses were both massive and timely. Although brief, the COVID-19 recession was steep and did a lot of damage to our state's economy. The peak to trough drop in employment was 11%, and that's actually worse than the 8% drop caused by the Great Recession. Georgia's unemployment rate soared to 12.2% in April, up from only 3.5% in February. On a more positive note, unlike the Great Recession, the COVID-19 recession did less damage to Georgia's economy than to the US economy. The nation lost 14% of its jobs to the recession compared to only 11% here in the state of Georgia. Our economic forecast for Georgia calls for the economic recovery to continue, and the main drivers of the recovery being consumer spending, a booming housing market, and Federal Reserve policies. Full recovery of the economy will arrive sooner here in Georgia than in the US. In Georgia, there's relatively less economic debris to clean up. In addition, many of the factors that caused Georgia to outperform the US economy prior to the pandemic are reasserting themselves. Some of the reasons why Georgia's economic recovery will outpace the US will include the build out of projects in our economic development pipeline, our competitive state level economic development incentives that will help refill our development pipeline. We'll get more leverage than most states from the housing boom, as well as more leverage than most states from the upturn in vehicle sales. There are good prospects for Georgia's military bases. Our state and local governments will face a less daunting fiscal challenge than those in many other states. And as in the past, our population will grow faster than the nation's, due mainly to immigration from other states. We expect the economic recovery from the COVID-19 recession to occur in 3 distinct phases. The first phase of recovery was the initial bounce in economic activity due to the lifting of stay-at-home restrictions and business reopenings. That phase is now over. Now we're in the second phase of the recovery, which is a more extended period of choppy economic growth that will linger until an effective vaccine is widely available and adopted. During this period, it is going to be a bit of a slog because we do not expect another round of widespread lockdowns of the population or shutdowns of businesses. Georgia's economy is not likely to slide back into another deep recession. The final phase of Georgia's economic recovery begins once an effective vaccine is widely available and adopted, which we assume will occur in mid-2021. At that time, GDP and employment growth will quicken, Georgia's economy will fully engage, and a period of steady, above average economic growth will begin. If we are correct that an effective vaccine is available and widely administered by mid next year, Georgia's GDP will increase by 4% in 2021. That is good compared to the 3.7% decline that we estimate for this year. And Georgia's GDP growth of 4% will be 0.5 percentage points higher than the 3.5% rate that we estimate for the US GDP next year. Georgia's labor market will also improve. The number of jobs will rise by 1.5% next year, which will be above the 0.9% gain estimated for the US. Most of those gains will come in the second half of 2021. Georgia's unemployment rate for 2021 will average 5.1%, or about 0.9 percentage points lower than the 6% rate that we estimate for this year. The prospects for personal income growth are not as good as the prospects for both GDP and jobs. The state's personal income will only grow by 0.2% next year, whereas US personal income will decline slightly. Our low expectations for personal income growth mostly reflect the wind down of the massive federal stimulus programs that provided large transfer payments to individuals in 2020, as Dave mentioned. The slowdown will occur even though that wage and salary-based income will grow faster next year than in 2020. I want to spend a few minutes to go through the phases of Georgia's recovery in a bit more detail. In late April, Georgia eased restrictions on businesses' operations and on people's movements. Many other states soon followed and opened up their economies. Despite contagion fears and social distancing, people emerged and many businesses either fully or partially reopened. Economic activity surged. There was a sharp increase in consumer spending. Retail sales on average quickly recovered and soon surpassed their pre-pandemic levels. In addition, home sellers and providers of services that could not be postponed any longer benefited relatively quickly. The initial bounce was uneven, with many types of businesses not benefiting much. For example, consumers strongly shifted from spending from services to goods, which helped retailers and manufacturers of consumer goods, but hurt service providers ranging from hair salons to hotels and motels. The labor market also rebounded. In the initial 3-month rebound, Georgia added back 55% of the jobs that it lost, and the nation added back 42% of the jobs that it lost. In the third quarter, GDP returned to 95% of its pre-pandemic level, up from only 90% in the second quarter. The initial rush to spend represents a rebound from extreme shocks and massive economic stimulus rather than economic reality. And that pace of economic recovery could not be sustained long term. In the final quarter of 2020, the pace of economic recovery is slowing. The economic realities of permanent job and income losses are settling in. Most of the large federal fiscal stimulus programs are winding down. An effective vaccine is still not yet available, and the COVID-19 pandemic continues. Official lockdowns are over, but many, even among those who are not on the most vulnerable populations, do continue to self-isolate. Almost everyone is practicing social distancing, which limits the spread of the virus, but also restrains economic recovery, especially for providers of many high contact services. In 2021, the balance of positive over negative forces should sustain Georgia's economic recovery. V-shaped recoveries for retailers and housing are the biggest positives, but they are also the biggest exceptions. An elongated U rather than a V will better describe the recovery for most businesses. It will help that many households have saved a lot and will spend some of their savings. Nationally, the personal savings rate will drop to about 8% next year. That extra spending out of savings should sustain the growth of consumer spending, which is vital to our recovery. The Federal Reserve will do whatever it takes to support the struggling economy, including keeping policy interest rates at zero into 2023. It is very good that COVID-19 dramatically accelerated the adoption of digital technology and remote work. That will support increased spending for high-tech equipment. Another positive is that depleted inventories and firmer orders will shore up industrial production next year. Next year, economic development successes will strongly support our state's economic recovery. Despite COVID-19, Georgia economic developers landed more economic development projects in fiscal year 2020 than in the year before. 9 of the 10 largest projects announced in the first 3 quarters of 2020 were actually announced after the COVID-19 shutdown began. This success reflects many factors that make Georgia a great state in which to do business, as well as an extremely competitive team of economic development professionals. Demographic forces are another factor behind Georgia's economic recovery. Next year, Georgia's population will grow at a pace that exceeds the national average at 0.8% here in Georgia versus 0.5% for the US as a whole. There will be many negative forces that will restrain Georgia's economic recovery. Most importantly, the pandemic is not over. Due to social distancing and contagion fears, many high contact businesses will continue to operate at greatly reduced capacity levels that may not be very profitable. Some types of businesses, for example, live entertainment, will remain essentially shut down. The debt that companies took on to survive the pandemic may limit their growth during the recovery, and the absence of large-scale stimulus programs, if not continued, will limit growth in 2021. Business and personal bankruptcies will rise next year, which will also be a source of layoffs. Put it all together, and economic growth will be weak until an effective vaccine is widely available and adopted. Now, we assume that 1 or more approved COVID-19 vaccines will be widely available and administered by mid-2021. If this assumption holds, the slog will be over and economic growth will accelerate in the second half of 2021. If it doesn't hold, it'll take a bit longer to reach herd immunity and in turn, longer before the economy fully engages and recovers. The expectation of above average pace of economic growth in the second half of 2021 reflects a dramatic broadening of Georgia's economic recovery to include even the most severely impacted industries and geographies, only possible because of the widespread vaccination of the population. For the first time since the pandemic began, high contact industries such as restaurants, hotels, and live entertainment will be able to fully engage, and regional economies such as Brunswick that are highly dependent on travel, hospitality, and tourism will gain traction and will rapidly move forward. Many businesses will find that they are significantly understaffed and will boost hiring, and consumer and business confidence will rise significantly. A virtuous cycle of above average economic growth will begin and will likely be sustained for several years. In the wake of the pandemic, job growth across Georgia's industries will be different than it was before the virus crisis. In 2021, industries hit the hardest by the COVID-19 pandemic will initially post the fastest growth, but the high percentage gains reflect rebounds off very depressed levels. Full recovery will take many years. Examples include bars, restaurants, hospitality, tourism, movie theaters, live entertainment, air transportation, high contact personal services, and the sharing economy. In contrast, logistics, distribution, warehousing, professional business services, information industry, Fintech, education, and health services will recover relatively quickly. In addition, positive job growth will occur in manufacturing, financial activities, transportation, and utilities, but full recovery may take a couple of years. Due to the strong housing market, home builders will be hiring aggressively next year, but poor prospects for commercial real estate markets means that non-residential construction firms will be laying off workers in 2021. Next year, retail sales will be strong, but retail jobs will continue to be lost as market shares shift to less labor-intensive channels. With disappointing revenue collections, state and local government jobs will decline in 2021. Next year, home sales and home building will be a major driver of Georgia's economic recovery. Housing experienced a V-shaped recovery in 2020, and activity will rise even higher next year. Low mortgage rates, job growth, and population growth are some of the traditional supports for housing that look to boost demand in 2021. In addition, telecommuting and social distancing made the home more important to people. Low yields on other types of assets probably means investors will be very active in residential real estate markets in 2021. Next year, we expect the number of single-family home starts for new construction to increase by 19% and new multi-unit home building to increase by 6%. Very impressive gains for an economy that is still struggling to recover. Another support for housing is appreciating home values. As of mid-2020, Georgia's existing home prices were 23% higher than prior to the Great Recession peak. The year-over-year increase in Q2 of 2020 was 4.5%. The degree of home price recovery, though, does vary widely across the state, as you see from the slide. Next year, home price appreciation will continue, but home prices will rise more slowly. We expect a 3% increase in home prices in 2021. One reason that home price appreciation will slow is that as mortgage forbearance programs wind down, more distressed properties will come onto the market in 2021. The outlook for manufacturing is positive. The main driver of growth in manufacturing production will be recovering demand for manufacturing goods. Due to factory shutdowns in the first half of 2020, there's also a need to produce more to restock stores and warehouses. Georgia saw many manufacturing economic development projects that were announced in 2020, and those projects will contribute to the increase in industrial production next year. The build out of headquarters projects will be an important force building Georgia's current and future economic growth. There are now 30 companies on the 2020 Fortune 1000 list that are headquartered in the Atlanta MSA. That's up 4 companies from 2019. In spite of the pandemic, Georgia competed very effectively for headquarters projects in 2020. For example, Papa John's chose Georgia as the location of its new global headquarters, and that will bring 200 jobs to the Atlanta MSA. IT, Fintech, and cybersecurity will strongly support Georgia's economic recovery. The list of IT and Fintech companies that have announced major projects in recent years is quite long. Several of those are listed on the slide that you see. IT, Fintech, and cybersecurity companies received a boost from the COVID-19 crisis because contagion fears pushed people to adopt new mobile technologies, including mobile banking and touchless payment systems. Most consumers are pleased with these services and will never return to their pre-crisis ways of banking and shopping. The digital transformation of many industries, ranging from healthcare to education to mobile banking, was an existing trend that the pandemic dramatically accelerated. The speed of this widespread digital transformation increases the risk of cyber attacks, which does put Georgia's cybersecurity industry onto a higher short-term and long-term growth trajectory. Due to the continued recovery of US and global GDP, the prospects for Georgia's very large transportation and logistics industry are very good. There are many logistics and distribution projects in Georgia's economic development pipeline. The slide lists some of those recent projects announced. This industry will benefit from Georgia's expanding role as a regional and national logistics and distribution center, as well as the accelerated shift from a physical retail to online retail. We believe the risks to the forecasts are skewed to the downside. COVID-19 is still the main recession risk. A dramatic worsening of the pandemic could cause the economy to go back into recession. Even if there's not a dramatic surge in COVID-19 cases, more federal fiscal stimulus may be needed to avoid a double-dip recession. A mistake in US government's response to the pandemic is a downside risk to our forecasts. Because risks are tilted to the downside, it is better to err on the side of too much stimulus rather than not enough. Recent rapid growth in lending to highly leveraged businesses represents another risk to the economic recovery. Corporate leverage is at historic highs, now 49% of US GDP. The Federal Reserve has taken notice of the rise in corporate debt levels and created a facility to buy corporate debt. Because interest rates are extremely low, leveraged lending probably will not trigger a double-dip recession, but it could worsen a recession triggered by another factor. There are still some geopolitical risks capable of triggering another downturn. Trade tensions with China and the high levels of sovereign debt are two of the most important. An escalation of the US-China trade war could cause another recession. Due to both the COVID-19 pandemic and insufficient deleveraging after the Great Recession, sovereign debt levels are very high and could bring on a global financial crisis. In closing, I am pleased to report that Georgia's economic recovery will continue and will continue strongly in 2021. The main drivers of growth will be consumer spending, a booming housing market, and Federal Reserve policies. COVID-19 is our main recession risk. The availability of an effective vaccine would remove that risk, and we assume that will happen in mid-2021. If correct, Georgia's economy will shift onto a steadier, above average growth trajectory, and that is good news for us all. Of course, there is more to the forecast than we can cover in a short program such as this. Each of you have the opportunity to retrieve the full version of the Georgia Economic Outlook as an ebook. The ebook provides an in-depth discussion of the forecasts for the US, for the state of Georgia, and for many of our state's metro areas. On screen, you'll see the link and promotional code Selig 21 to download your copy of the forecasts. I want to again thank Dr. David Altig for his national forecasts, and also thank all of you for supporting the Terry College of Business and the University of Georgia. We wish you the very best during the holidays and a happy and prosperous 2021. Thank you.